Welcome to the Deep Dive, where we tear open the transcripts and unpack the critical shifts shaping the market. Today, we are focusing on the Q4 fiscal year 2025 earnings results for QuantaSing, or QSG, but really this isn't just an earnings review, is it?
No, not at all. This deep dive is necessary because we are looking at a company attempting one of the most, comprehensive strategic pivots we've seen recently. Our mission today is really to understand the logistics and implications of that transformation, moving QSG from a complex, sort of multi-segment online learning provider to a pure-play consumer IP company focused entirely on pop toys, a massive shift.
A full corporate identity change, essentially. And management came out with, solid, maybe even surprising profitability. Plus, they coupled that with extremely aggressive guidance for this new focus area.
Exactly. But the market reaction was hesitant? Is that fair?
I think so. We saw a modest pre-market bump, but then the stock kind of faded into the regular close. It really feels like investors are struggling to price the risk, the risk of this high-speed pivot against the potential reward of this clean slate they're creating.
They are struggling because the numbers, frankly, tell a story of intentional destruction, almost. QSG is literally tearing down the old model to build something completely new, and you can see that clearly in the financials.
Okay, so let's get the headlines out first for everyone listening. Q4 FY25 revenue came in at RMB 617.8 million. That's about, US $86.2 million?
Roughly, yeah.
And the really big headline number here is the negative 38.2% year-over-year decline. I mean, that's a staggering contraction.
It is huge. But, and this is the key point, look at the bottom line. Adjusted diluted EPS came in strong at RMB 0.67, so about 9 US cents. And that was supported by a remarkable adjusted net margin of 18%. 18%.
Okay.
So they clearly managed to, cut fat much faster than they shed that top-line revenue.
That 18% margin immediately makes you ask, where did they find that efficiency? Because the gross margin stayed pretty robust, right? 75.7%. So the core service itself wasn't the issue there.
No, the magic definitely happened lower down in the expense line. Operating expenses dropped a massive 44.7% year over year.
44.7%. And the driver?
The biggest swing factor was sales and marketing, S&M. That budget, which, let's be honest, used to be the absolute lifeblood of their expensive traffic-driven learning business.
Yeah, it had to be.
It decreased 49.3% year over year, almost cut in half.
Okay, and here's a metric we really need to unpack for you listening. S&M intensity. It dropped dramatically to 47.6% of revenue. That's down from 69.2% just the prior quarter. I mean, that's a massive operational shift.
It's huge. Exactly. S&M intensity, just to clarify, is basically the percentage of every dollar earned that they had to spend on marketing just to get that dollar of revenue. So when that drops from nearly 70 cents on the dollar down to 47 cents, it's the clearest possible proof that they deliberately choked off that expensive, high-volume traffic acquisition model. They are prioritizing profitability, leaner acquisition economics over just chasing top-line scale.
And crucially, they've got the cash to do this without, hitting the wall financially. They're sitting on a solid cash base, RMB 1,040.9 million. That includes cash, restricted cash, short-term investments. It's a significant war chest.
It is, and that cash isn't just a safety net, it's absolutely essential. Because this transformation isn't just about cutting costs, it's about starting a completely new consumer manufacturing and retail company, basically from scratch. That requires huge upfront capital for IP creation, channel build-out, all of it.
Right, so the numbers confirm the slowdown was intentional. Makes sense. But intentionality implies an end goal. What was the corporate announcement that really formalized this new pure play identity?
Yeah, the post-call corporate update was definitive, no ambiguity. They plan to divest all online learning operations, all of it. Terminate the legacy variable interest entity, the VIE structure, and rebrand entirely as Here Group Limited. They're planning to trade under the ticker HERE, HERE.
Okay, just to clarify for listeners who might not track M&A jargon constantly, terminating that VIE structure, that's a huge deal. It's often done to simplify the ownership structure, especially for international investors, makes the company cleaner, easier to understand.
Exactly. They are completely divorcing themselves from the legal and operational complexity of the past. It's a clean break.
And this divestiture of the legacy business, there's actual money changing hands.
Yep. It includes consideration of RMB 162 million plus another US $2.5 million. So the old business is now, essentially collateral damage in this pivot, traded for future focus.
They're betting everything on the success of one thing, Pop toys.
One thing, pop toys.
The market narrative has just completely flipped overnight. Okay, so let's look at this new core engine. How did the Pop Toy segment actually perform in its first full quarter?
Yeah.
This was under the Let's Van unit they acquired, right?
That's right, Let's Van. So in Q4, the Pop Toy segment brought in RMB 65.8 million in revenue.
Okay.
Which is, a pretty healthy baseline, especially when you consider their flagship IP, WAKUKU. That single IP contributed RMB 43.0 million of that total.
43 out of 66 million, roughly.
Yeah. So that immediately shows the power of having a successful brand, a hit IP, within the portfolio.
And they're clearly focused on building more of those. IP creation, brand distribution. They mentioned operating 15 total IPs, 11 of which they own themselves, spread across, over 40 blind box product lines and 30-plus pendant card products.
That's right. They have to prove they can iterate quickly, keep things fresh, and they are showing some velocity there. The WAKUKU Fox and Bunny series, for instance, achieved over 1 million units sold. That's significant volume.
1 million units.
But what really stood out to me personally was the launch of their new IP, Sonono.
Okay.
It sold out 10,000 units in just 10 minutes at their flagship store opening. 10 minutes.
Wow. 10,000 units in 10 minutes. That's not just a product launch. That feels more like a genuine cultural moment they managed to capture there.
It does, and they've sold approximately 300,000 units of Sonono to date. So initial traction is strong.
But does that kind of velocity put impossible pressure on the rest of the IP pipeline?
That is the million-dollar question, isn't it?
The demand signal is obviously there for a hot product, but can they replicate that? Can they meet demand consistently across multiple lines?
That's the challenge, and it's why their multi-channel approach is so critical. Online, they're definitely creating buzz. You look at the social media numbers, over 550 million views on Douyin, 140 million views on Xiangshu for their content.
Huge numbers.
And their online gross merchandise volume, GMV, exceeded RMB 18 million back in August. That's apparently a 9-fold increase from April's level. So the social media engine is working, driving sales.
Okay, and then linking that online buzz to physical sales channels.
Yeah.
They mentioned a massive wholesale network.
Yeah, over 10,000 retail stores in their wholesale network. Plus, they plan to open 3 to 5 of their own self-operated flagship stores by the end of December.
Right. That integrated offline distribution model is pretty essential in the collectibles space, isn't it? Building that brand experience.
Absolutely. But we also need to talk about the operational challenge behind all this growth.
Okay.
Management started that the monthly output of their mainstream plush products increased more than 20-fold since January 2025.
20 times.
20 times. It now exceeds 1 million units per month.
Okay. 20-fold scaling in less than a year. Sounds amazing from a growth perspective, obviously, but that's also a massive operational risk, right?
Yeah.
Shifting production capacity by that amount, it puts enormous execution pressure on their logistics, quality control, everything.
Huge pressure. It's pure execution risk. And you have to keep that front and center when you look at their guidance.
Which brings us right to it. That 20x scale up leads directly into their, frankly, aggressive forward guidance, which, as you said, necessitates flawless execution.
Yeah, they really didn't pull any punches about where they expect this to go.
So let's look at the acceleration required. For Q1 fiscal year 2026, that's the current quarter they're in, they project Pop Toy revenue to hit RMB 110 million.
Right, which is already a huge step up from the Q4 number we just talked about, that RMB 65.8 million.
It is, but the full year target.
Yeah.
That's the real headline grabber for investors, I think.
Definitely. FY26 projected Pop Toy revenue, RMB 750, 800 million.
750 to 800 million RMB. Just from Pop Toys.
Just from Pop Toys. To achieve that, they need to sustain massive, continuous acceleration quarter after quarter. They have to prove they can manage that 20x supply chain increase and keep creating culturally relevant IP that hits, consistently throughout the year.
So what gives management the conviction to set such an incredibly high bar? There must be something underpinning that confidence.
Well, one clue is in the details of how they acquired the remaining equity in Let's Van, the Pop Toy unit.
Ah, okay. What happened there?
The founder of Let's Van opted to receive 60% of the consideration in newly issued QSG, now here group shares.
Okay, taking stock instead of cash.
Exactly. And the remaining 40%. That's structured as long-term incentives vesting over 8 years.
8 years. Wow.
That's an extremely important detail, I think. An 8-year vesting schedule signals deep, long-term commitment. Management is now perfectly aligned with the shareholder vision for the next decade, essentially. They're getting paid in future growth, not just upfront cash.
That makes sense. Significant skin in the game. And beyond that alignment, did they offer any hard evidence for demand?
They did. They backed up their confidence with some pretty strong demand visibility comments. They stated that their current delivery rate is less than 50% of confirmed orders.
Less than 50%. So they've got orders booked way out.
Yeah, it means they have a significant backlog and a production planning pipeline that supports their confidence in hitting that aggressive RMB 750 million plus target for the full year. Basically, they're saying, we have the orders, now we just need to produce and deliver the goods.
Okay, which circles back to that execution risk,
Yeah.
but at least the demand seems to be there.
Right. And delivery also relies on reach, expanding their market. So they're leaning heavily on strategic cross-industry partnerships to accelerate both their IP iteration speed and their market reach.
Which ones did they mention?
They cited collaborations with the China Open Tennis Tournament, Universal Studios, Genki Forest, the beverage company, and even Beijing Fashion Week.
Interesting mix.
Yeah, these moves seem crucial for expanding their brand appeal beyond maybe their core user base and trying to minimize that risk of being too reliant on just one trend.
Okay, so if we connect all these pieces for you, the listener, the investor perspective here,
Yeah.
the investment thesis is really characterized by this extreme conflict, isn't it?
Absolutely. You had this solid cash-generating, albeit complex, legacy business
Right.
that has now pivoted completely into a high-growth, high-risk, pure-play consumer collectible sector.
And the risk profile is now fully concentrated. There's no hiding.
None at all. The stock's performance hinges entirely, almost solely, on hitting that RMB 750 million to RMB 800 million FY26 revenue target for Pop Toys.
Yeah.
If they hit it, or show a clear path to hitting it, the complexity of the pass is probably forgiven.
But if they miss,
If they miss, the lack of diversification becomes a really severe liability. There's no other business segment to cushion the blow.
and the market action seems to reflect this tension, right? You mentioned QSG's one-year return was huge, over 120%, significantly outpacing the sector.
Yeah.
That suggests optimism about the pivot potential.
Correct. But more recently, QSG has lagged in the 1 to 3 month performance,
Okay.
which suggests the market is now in wait-and-see mode, waiting for proof of execution in this new singular model.
As we said earlier, the market actually faded the stock on the earnings news, despite the cleaner cost structure and that strong cash reserve.
Right, which I think suggests investors recognize that this pivot moves the company away from operational complexity like managing expensive traffic acquisition and towards pure, almost binary execution risk against very measurable, very aggressive financial targets. It's cleaner, yes, but it's also incredibly high stakes now.
So that really raises the question, doesn't it? When does pure execution risk, maybe combined with this clean organizational break, actually translate into an opportunity for, let's say, the discerning investor?
Well, that leads us nicely into thinking about potential strategies here. Let's turn our attention maybe to the high-risk, high-reward strategy inherent in this kind of pivot. And just to be absolutely clear, this is not financial advice, but we can outline how a deep analysis of this call could lead someone to a focused, maybe plausible trade idea based on the upcoming catalysts.
Okay, lay it out. Given the dramatic shift, the ambitious guidance, the stock is arguably depressed because of that execution risk we keep talking about. So the goal, if you were considering this, would be to invest only when the story simplifies further and there's some tangible proof of concept visible.
Exactly. So, catalyst number 1. The Extraordinary General Meeting, the EGM, scheduled for November 6th. That's for the rebrand to Here Group Limited. That event, if approved, is a short-term catalyst that vastly simplifies the corporate story, especially for Western investors. Gets rid of the old baggage associated with QSG.
Okay, simpler story. But what's the real test?
The real binary event, the make-or-break moment, is the Q1 FY26 revenue report. That's expected sometime in early calendar 2026. That report will either confirm or deny whether they're actually on track, whether they're capable of hitting that RMB 750 million annual target floor. It's the first real data point on the new strategy's traction.
Right. So putting those together, the plausible, again, not advice trade idea here, could be something like a medium-term long position. But it would be explicitly contingent on 2 specific conditions being met.
Condition 1.
First, the EGM and the rebrand to Here must be approved. That signals the clean break is official, the new identity is locked in. Second, and this is crucial, the company needs to be showing, maybe through interim updates or just market sentiment, a clear communicated path toward hitting that Q1 FY26 pop toy revenue guidance floor. that RMB 100 million number we mentioned.
Gotcha. So you're not buying before those signals. You're waiting for confirmation.
Exactly. This focuses the potential investment exclusively on the proof of concept for the new, potentially high-margin growth engine. It minimizes the risk of just holding shares through ongoing organizational uncertainty or hoping the execution works out. You wait for evidence.
Makes sense. So to summarize everything for you listening, QuantaSing is now effectively Here Group Limited. It's a fully focused pop toy play, period. They have an ambitious growth target, a significant cash runway to fund it, and a highly incentivized management team that seems locked in for the long haul, judging by that vesting schedule.
The speed of their IP creation, their channel expansion efforts, and especially that massive supply chain scaling, it really is breathtaking, potentially. But because they chose this pure play model, execution, hitting those numbers, managing that growth, now matters more than literally ever before for this company.
It really does. And maybe a final thought to leave you with. We encourage you to consider how management's willingness to just completely divest the entire legacy business, sacrificing all that immediate scale for complete strategic purity. How does that impact your view of the pop toy market's overall potential?
Yeah.
That level of conviction of betting the farm suggests maybe they see a runway and opportunity that most of the market is currently underestimating. Or maybe they're just overly optimistic.
Food for thought. That wraps up our deep dive into the QSG to here transition. We'll catch you next time on The Deep Dive.